Director of Cross-Border Capital, Michael Howell, puts forward the hypothesis that global liquidity will start to grow in the near future, thereby pushing up all risky assets. Let's listen to the essence of the theory.
And what the chart is demonstrating, the black line, is an index we put together, which is showing the flow of global liquidity through world financial markets. It's an index from 0 to 100, 50 is neutral, and a rising index is a lot better than a falling index. The sine wave on that chart is trying to indicate the direction and the sweep of that cycle looking forward. So what we can see here is a bottom in the global liquidity cycle in October of last year. Liquidity leads markets, remember. And so what that would tell you is we're switching from a headwind facing investors to now a tailwind. Many macroeconomists were arguing that 2023 was going to be a bad year, was going to be a recessionary year, would be a time when you wanted to just stick into cash. That has not been true. Liquidity again has been a major driver and a key thing to watch. And what we would envision from that chart is the next peak in the cycle does not occur until late 2025. So what we were doing then was using the data set from 1970 to 2000 to fit that sine wave to the black line. And we've run it on consistently without alteration thereafter. So what you see is what you get. And what it traces out are average 65-month cycles. And that seems to be the repeating cycle of global liquidity. Why that is, I don't know for sure. I've got various theories as to why you get there, but none of them are particularly outstanding, if you like, or the true explanation. So it's a combination of things. But what you can see, particularly if you look recently, is the global liquidity cycle hit a low point about 2018, 2019, rocketed upwards through the COVID crisis as you saw central banks injecting lots and lots and lots of liquidity. It then started to crash as central banks reversed course, and it hit a low point around October of 2023, and it's picked up thereafter. Now, there is no question, and I'd be incorrect to say this, that liquidity is currently low. It's not high, but it is expanding, and it will likely, not certainly, but likely trace out that path as articulated by the dotted line there, and it will peak around late 2025 if we're correct.
I hope you understand the idea. This chart shows periods when liquidity reached highs and lows. The red dashed line predicts its future movement, in this case, an increase. A crucial point to note when we talk about lows is that it doesn't necessarily mean that liquidity was contracting at that moment. It could simply not be growing. Let's hear what he says next.
Now, what we've done in this chart is to draw up global liquidity as a stock rather than the index of rate of change that we previously saw. And the black line there is showing the path of global liquidity over time. And that chart is scaled on the right-hand side. So what you're looking at here is a figure of around $175, $200 trillion for that pool of liquidity. Now, as I said, what's driving that are the central banks. The central banks are beginning to push more cash into the system, but that gets progressively levered up by private sector credit providers. Why are the central banks doing this? The main reason is that there are such heavy debt burdens to fund from the public sectors that it's increasing pressure on the monetary authorities to take up some of that debt themselves. Now, what that is normally thought about is so-called quantitative easing.
This chart depicts global liquidity, and the far right part of the chart is their forecast that it will continue to grow. The next chart illustrates what I mentioned a minute ago. When we observe a liquidity minimum on the first diagram, it doesn't always mean that global liquidity is decreasing. The essence of their idea is straightforward: central banks must intervene. There is currently too much debt in the system, and more new debt is needed to support it. Another round of quantitative easing QE will be launched, increasing bank reserves, and banks should be incentivized to lend to the private sector. All of this is expected to boost global liquidity, and in their opinion, risky assets should start to rise as a result. Well, that sounds quite promising. I've also mentioned several times that the growth of global liquidity has a positive impact on markets. But let's try to understand everything more thoroughly. The first thing that stands out is that liquidity always grows over the long term. This is similar to inflation. Prices will always rise. Sometimes, during a crisis when demand decreases, there may be months or even a couple of years when prices fall, but the fact remains that, if not in a month, then in several years, prices will still be higher. So when Michael predicts liquidity growth in the next 3 to 5 or 10 years, I don't see much sense in that. If he had said what would happen with it in 1 or 3 months, the value of this information would be much higher. Because it would provide an idea of where the dollar is headed in the near future, what will happen to bond yields, and how gold will behave. Building a long-term forecast for these assets is quite easy. We know that the Federal Reserve will soon start lowering rates, then a printing press will be launched, and because of this, bond yields in the long term are expected to decline, and the dollar should also depreciate. Since gold and bond yields are inversely related, there is a very good potential for growth. But I find it more interesting not to look so far ahead but to try to forecast what awaits us in the foreseeable future. And if we zoom in on this chart and overlay the dollar and bond yields, it can be seen that these two assets are currently in a very clear inverse relationship with liquidity. When there are problems with liquidity and a shortage of dollars appears, it naturally starts to appreciate. Simultaneously, bond yields begin to rise because bonds are sold in exchange for the lacking dollars. When the liquidity situation evens out, these assets reverse. One thing needs to be understood here. Liquidity is not a completely linear asset, and the maneuvers of various financial institutions cannot be predicted. So, even if a quantitative easing program is underway and it seems that banks are lending less, liquidity can sometimes increase. This is generally normal. On the other hand, during a period of tight monetary policy, its growth will be limited. And most importantly, it is crucial to consider that global liquidity is also sensitive to sentiments. That is, when risks emerge, it starts to contract. Take the example of the year 2020. The Federal Reserve promised to save everyone, launched the printing press, lowered rates to zero, but liquidity went down. Or in 2008, back then, the printing press was running at full capacity, rates were falling, but for some reason, global liquidity was also falling. Well, let's say someone suggests, maybe in 2008, global liquidity was falling because the stimulus program was launched only in the USA? Perhaps the dollar's global liquidity was rising, while all others were falling, creating an overall effect? Okay, let's then separate the dollar's global liquidity from global liquidity, if we can put it that way. The charts will be somewhat similar. Now, the green graph represents global liquidity excluding the dollar, and the orange graph represents global dollar liquidity. Over the past year, you've probably heard that there is an acute shortage of dollars globally, and now, looking at these graphs, it seems to be the case. There is indeed less actual dollar liquidity. But let's go back to 2008, and here we also see that despite the stimulus program, dollar liquidity inexplicably dropped. Now, something interesting from 2012 to 2014, there was a QE program, and according to authoritative opinions, it should have led to an increase in liquidity. At a certain point, it seemed like there was growth, but the program did not finish, and liquidity had already started to decline, and after 6 months, it reached 2012 levels. It's especially fascinating to observe this dynamic in comparison with bank reserves, which, by the way, are primarily influenced by the Federal Reserve's policy. Reserves practically did not change over the same time frame. However, from 2015, as the printing press was halted and interest rates started to rise, reserves started to shrink, but liquidity continued to grow. From 2020 to 2022, they both grew together, and now they are slightly falling, but not quite synchronously. Either liquidity will increase, and reserves will remain unchanged, or liquidity will decrease, and reserves will also not change, or both will grow. Therefore, all these discussions about the impact of QE or bank reserves on liquidity seem like empty talk. Of course, if you shrink the graph, everything looks generally growing. And sometimes, during a massive downturn, everything looks like it's falling. But in the moment, as it turns out, liquidity can both fall during a QE program and rise during a QD program. But the most crucial question that stirs the minds of investors is, does global liquidity really have a direct impact on what happens in the market? What I can say is that looking at these graphs over a 20 to 30 or 50-year scale creates a persistent impression that, yes, there is an impact. Global liquidity grows, and markets also grow. But if we look at the period from 1995 to 2000, we find that markets somehow managed on their own. However, from 2000 to 2002, liquidity was rising, but the market was falling. From October 2007 to July 2008, liquidity was rising, and the market was falling. Then, despite the printing press, they fell together. From November 2008, liquidity began to grow, and the market dropped by about 20%. In 2009 to 10, despite a reduction in liquidity, the market held steady. From July 2014 to March 2015, it continued to grow, and from April 2015 to March 2016, when it seemed like liquidity was returning, the market corrected a couple of times by 15%. You can continue further, but as you can see, there is no clear correlation. Here is an illustration of what a clear correlation means. For example, the correlation between the dollar, bond yields, and gold. I've explained countless times that this connection has existed since the abandonment of the gold standard, and besides these two, gold is not influenced by anything else. In other words, if a decrease in both bond yields and the dollar is forecasted, gold is destined to rise. If they move in different directions, gold will either remain flat or lean towards the asset that has risen or fallen more strongly. If the dollar weakens significantly and bond yields slightly increase, it's still positive for gold. Another example of a clear correlation that allows assessing the economic environment is copper versus gold. When we divide copper by gold, a beautiful descending channel is formed. Here, whether it's a rising or falling channel is not important. What matters is that the levels are clearly visible. When this graph rises, it means copper is showing better dynamics relative to gold. When the graph falls, on the contrary, gold is winning. Copper is an industrial metal, while gold is primarily a safe haven. When this graph is near the support level, one can assume that the economy is about to revive, indicating a favorable environment. Near the resistance level, it's the opposite, signaling that the boom is past and preparations need to be made. The only time there was an upward breakout was in 2005 to 2006, but then there was a real estate market boom, and since copper is an industrial metal, it actively rose. This is what is called trading beauty, where the dependence is visible, and the influence of one asset on another can be explained. Let's summarize all the above. Firstly, as it turns out, there is no clear correlation with the actions of the Federal Reserve and how it affects liquidity. Secondly, liquidity can change depending on economic conditions and sentiments. Thirdly, despite a general trend that growing global liquidity positively influences markets, it's appropriate to talk about this on a multi-year scale because, as seen, discrepancies can last for months. Fourthly, in the current medium-term planning, it is much more important to consider not global liquidity but the liquidity of the Federal Reserve, and currently, everything indicates that its growth is under pressure. I will explain what it is and how it affects markets in the next installment. Well, fifthly, concluding the discussion on global liquidity and its impact on markets, it's essential to keep in mind the following. First, its rapid growth is possible with a complete reversal of central banks, including the launch of printing presses and the like. Second, thanks to QT, the dollar is still being drained from the system, so in the next few months, it is more likely that we will not see a swift rise. And if some disturbance occurs in the near future, and there is a probability of that, it may exert pressure on global liquidity. Therefore, answering the question of whether it will help the markets in the near future can be said very simply. On individual days, it may provide support to the markets, but since the discrepancy between the market and liquidity is becoming very significant, there is a high probability that the market will undergo a downward correction in the near future.